Now, business news, and China's central bank has cut interest rates in an effort to boost flagging economic growth. New figures show industrial output grew at just 3.8% in July, lower than expected. Retail sales have also slowed, and investment in the property sector has plunged. The interest rate cut suggests the government there recognizes it can't achieve its growth target of 5.5% for the year. Well, how will that slowdown in China affect global markets? We don't have the one person who can interpret all of that. We don't have her immediately. Our Rise Business correspondent, Laurie Laird, she is, I'm told, busying to join us. I'm not sure whether we have her yet or not. Okay, we've got Laurie. She's also going to be discussing what's happened in China in the context of those rather disappointing inflation figures out of Nigeria. Good to see you, Laurie. Let's start with China. How bad were today's economic figures?
And I apologize for the delay, Charles. I think I'm told that my image is not as sharp as today, so I'll try and speak more clearly so that I can at least make my point. But let's start with those China data. On the surface, it doesn't look quite that bad. Industrial production was up. It was down in the month of June. Retail sales are down a lot in the month of June, up a little bit in July. But both of those metrics, and they're both very important metrics, industrial production, retail sales, both up by a lot less than analysts were figuring that would happen, mostly because June was such a very bad month. Much of Shanghai and other big cities were in lockdown. So the hope was that July would be a much bigger bounce back, and that has not been the case. And I think that's why the People's Bank of China, the central bank, cut interest rates today. Now, many economists have been saying that China does need some kind of monetary stimulus, that the government and the central bank are going to have to do something because the economy is slowing so very quickly. Yet, this cut by the People's Bank of China did catch a lot of analysts by surprise. They didn't expect it to come so quickly.
So, I mean, beyond the significance of this rate cut, I mean, are you expecting things to get worse?
Absolutely. And this rate cut, Charles, was very meager. It was 10 basis points, a tenth of a percentage point. That took the what's called the 1-year bank rate down to 2.75% from 2.85%. So it's more a symbolic move than it is a move that will really put much more liquidity into the market. But I don't think there's anybody that thinks that things will not get worse before they get better. And a couple of things are going on here. One is China's decision to stick so closely to this no COVID policy. And while we're seeing a little bit of economic activity in Shanghai again and in Shenzhen, which is so crucial to economic or manufacturing, particularly technological manufacturing, now we're seeing some shuts down in Urumqi in the northwest province, less of a manufacturing area, but still a big province nonetheless. A lot of shutdowns in Hainan, which is a resort town on the southeast coast of China. In fact, people were not permitted to leave resorts there, and they're starting to riot a little bit because they can't get out. So we are seeing these localized shutdowns, and it doesn't feel like the government is going to come away from this policy anytime soon. The other thing that could be even more troubling for the Chinese economy is this desperate fall in property values, in property activity, which at one point at its most robust was accounting for about 22% of Chinese GDP. Now we've seen a lot of property developers have got into trouble. We're seeing a lot of purchasers who bought places off plan that hadn't been completed yet are saying, wait a second, we don't know whether our apartments will be completed, and we're going to boycott paying our mortgages, which could really hit the bottom line of these property developers. So there are two big things colliding in the Chinese economy. And that's in addition to all of the other difficult things that we're seeing around the world.
Well, I mean, as you sort of assess the global implications of this data out of China, let's also look at Nigeria. Some fairly worrying inflation data emerging today.
Yeah, Charles, I hate to be doom and gloom here, but these are desperate, desperate numbers. Inflation up to 19.6%. That is the highest we've seen in almost 17 years, up a full percentage point from the month of June. And it doesn't feel, what we're seeing with food prices, with energy prices, it does not feel as if things are going to get better on the inflationary front in Nigeria anytime soon. Remember, the central bank has a band in which it wants to keep inflation. The upper level of that band is 9%. We're more than twice as high as that. Extremely worrying. And again, with food and energy being the main drivers of inflation, you think in Nigeria that the average family spends so much more of its income on food and energy. So this really, really does hurt much, much more than it does in the West. Food price inflation up 22% year on year in the month of July. That really is going to hurt a lot of families.
Very briefly, Laurie, does this mean the central bank is likely to continue raising rates?
Absolutely. I think we'll get another 50 basis points on the main interest rate to 14.5% in September. But then, of course, we're getting into an election season after that. I think the central bank, while it is independent, will certainly have a sense of an election coming up in February. So I think that the interest rate hikes may slow down after that.
And just before we go, Laurie, Moscow reopening its bond markets to so-called non-hostile foreigners. What's all that going to mean?
Well, at this moment, there aren't that many non-hostile states to Moscow. So it's not as if all that many countries will be getting in on the action there. But that means that these entities considered to be non-hostile, which China, Turkey, a couple of other countries, can go back in and purchase and sell Russian government bonds. Now, these non-hostile actors only made up about 10% of the fixed income markets in Moscow prior to Moscow closing the markets back in early March. So I can't see that allowing them to come back into the market is going to make much of a difference.
Laurie, we're up to date. Thank you very much indeed.
Thanks, Charles.
Laurie Laird, Arise business correspondent, giving us her global assessment of business developments around the world.